Welcome to this explainer. Today, we're putting on our sell-side equity analyst hats to produce a rigorous, fully documented stock valuation of Tutor Perini, trading under the ticker TPC. We are going to dive straight into the fundamental data to unpack what is honestly a pretty fascinating market story. We'll build out our valuation analysis step by step, evaluating the business purely through the numbers to, really separate the market noise from the true intrinsic value.
And wow, what a story it is. We're looking at a staggering trailing 12-month return of 315.67%. I mean, if you follow the market at all, a number like that immediately grabs your attention, right? But as analysts, our job isn't to just chase momentum, it's to measure actual value. So my goal today is to methodically crunch the numbers, extract the cash flow realities, and see if this explosive run-up is actually justified by the company's intrinsic value, or if the market has just completely gotten ahead of itself here.
Okay, here's our roadmap for today. We're going to cover 1. The turnaround mystery, 2. Relative valuation, 3. Discounted cash flow, 4. Alternative models, and 5. The verdict.
Let's jump right into Section 1, the turnaround mystery, tracking TPC's massive run-up.
This timeline brilliantly illustrates the stock's complete reversal. Just look at where we started, a nearly 39% drop in 2022, but then the narrative shifts violently. We see a modest 20% gain in 2023, followed by absolutely explosive triple-digit returns in 2024 at roughly 166%, and then 2025 at an astounding 177%. And get this, the momentum hasn't even stopped, continuing with a nearly 45% gain year-to-date in 2026. This isn't just a bump, folks, it's a structural re-rating of the stock.
But hey, a stock chart without fundamentals is just a squiggly line, right? Behind that wild price action is a massive fundamental engine. Tutor Perini is generating over $5.5 billion in trailing 12-month revenue. But the number I really want you to focus on here is the free cash flow, a powerful $567 million. Now, while net income sits at a more modest $80 million, that massive free cash flow relative to a $5.1 billion market cap tells us their cash generation is highly, highly robust.
Moving on to Section 2, Relative Valuation and Multiples, comparing TPC against itself. So to maintain our analytical rigor, we need to state a clear limitation up front. Our source documents don't list explicit peer companies. Instead of guessing who their closest competitors are, we're using the company's own historical baselines as our benchmark. Now notice the dramatic compression in the enterprise value to EBITDA ratio. It literally crashed down to 1690 from an astronomical 3-year average of over 288. This tells us operational profitability has surged, bringing that valuation multiple right back down to earth. At the same time, price-to-book and price-to-sales ratios have roughly doubled compared to their 3-year averages. Basically, the market is paying more for the assets and top-line revenue today because the underlying efficiency has vastly improved. This story builds even further when we look at earnings. Check out this stark contrast. The trailing PE sits at a super high 63.80, but the forward PE plummets to just 14.01. This massive divergence means analysts expect incredible near-term earnings growth. The market isn't pricing Tutor Perini for where it has been. It's aggressively pricing it for where the earnings are heading.
And if you want validation of that exact expectation, just look at this extraordinarily low PEG ratio of 0.43. For those of us focused on valuation, a PEG ratio under 1.0 is generally the gold standard for growth at a reasonable price. To translate that simply, you are paying very little for the company's anticipated growth. The earnings acceleration is drastically outpacing the multiple expansion.
All right. Section 3, Discounted Cash Flow Analysis. This is the absolute valuation engine. To calculate intrinsic value, we're relying specifically on a free cash flow-based discounted cash flow model, derived directly from the robust source data. The primary input powering our model is this multi-year explosion in free cash flow. Notice the compounding annual growth rates we've got plotted here. The trailing 12 months show almost 22% growth, but over a 3-year timeline, it peaks at an incredible 56.7%. When a company can sustainably compound its actual cash generation at these rates, it's a real game changer for its intrinsic value trajectory. So what happens when those phenomenal cash flows are forecasted out and discounted back to their present value? Well, the model outputs a truly eye-popping implied intrinsic value. The fair value price, based entirely on this free cash flow metric, comes out to $799.37 per share. Now contrast that with the current trading price of just around $96.98. The mathematical model suggests the cash-generating power of this firm is currently vastly underpriced by the broader market. Which brings us to the absolutely crucial point here, this calculated margin of safety of 87.87%. As fundamental analysts, the margin of safety is our cushion against unforeseen errors or macro market downturns. An 87% margin of safety means the stock is trading at a massive discount to the present value of the cash it is structurally projected to generate. Honestly, it's an incredibly rare valuation signal to see in the wild.
Now for Section 4, Evaluating Alternative Valuation Models and why DCF stands alone here.
A rigorous analyst has to evaluate all the tools in the toolbox, right? So let's examine why alternative absolute valuation models fall short based on the data we have for TPC. First up, we absolutely must reject the dividend discount model. We've got a near zero dividend yield of 0.12%, with literally zero historical growth over the past 3 and 5 years. When a company has no consistent growing dividend policy, trying to forecast a multi-stage dividend model provides no reliable basis for valuation whatsoever compared to our cash flow method. Furthermore, we are explicitly skipping some of the parts, adjusted present value, net asset value, and residual income models. Actually, scratch that, we didn't just skip them, we had to exclude them. Why? Because our source documents lack the segmented operational reporting, precise debt schedules, and granular balance sheet line items required to run them accurately. Without explicit breakdowns of different business segments or exact market values for unlisted assets, attempting a sum of the parts or liquidation valuation would require pure guesswork. And we don't do pure guesswork here, it goes against our disciplined, data-driven approach.
Let's wrap things up with Section 5, the final equity value verdict, focusing on the pricing disconnect.
Relying on our most robust available data, that free cash flow, let's bring all these numbers together. Despite a monumental 315% run-up over the last 12 months, TPC is still generating an incredibly healthy 11.12% free cash flow yield. It's trading at a steep mathematical discount to its intrinsic fair value of $799.37. The fundamental inputs, driven by $500 million in free cash flow and ultra-low forward multiples, paint a picture of a company whose underlying business improvements are literally outrunning even its soaring stock price.
All of this leaves us with a really provocative final question to consider. Is this 87% margin of safety a rare, deeply entrenched market inefficiency just waiting to be fully realized? Or does it signal underlying operational or sector risks that simply aren't captured in the raw historical cash flow projections? The math clearly screams undervalued, but as intelligent investors, it's up to you to dig into the qualitative story behind these extraordinary numbers. Thanks for joining me on this Valuation Explainer.